Watch this entire video before you form an opinion. Every section builds directly on the one before it. If you skip ahead, you will get an incomplete picture and you will misread what the data is actually saying. This video runs approximately 10 to 12 minutes. That is a small investment for what is a genuinely important market moment. Stay with it from start to finish. In the last video, the call was straightforward. Silver needed to hold the 74.20 level on a daily body close to preserve the broader bull structure. The statement was that a confirmed hold above 74.20 would open a path toward the $78 to $80 resistance cluster within 2 to 3 weeks. New viewers, go back and check the timestamp on that video. The chart is right there. That level held. Silver did not close a daily body below $74.20, and within 11 trading sessions, price moved to tag 79.80 before the move we are discussing today. That was not luck, that was structure. Now let's get into what is happening today. Silver hit $82 per ounce in the spot market during today's London session. That is not a rounding error. That is a number that, 18 months ago, the majority of institutional forecasters said was a 5-year target at minimum. It happened this morning. The COMEX front-month futures contract printed $82.34 at its intraday high. Shanghai silver futures on the SHFE reached the equivalent of $83.10 in dollar terms, a premium of roughly $1.10 over the Western spot price. Total silver market capitalization, using above-ground investable supply estimates, added approximately $48 billion in value in a single session. That is not a minor move. In percentage terms, silver moved 6.2% in a single trading day. That is a commodity behaving like a micro-cap stock. The question nobody on mainstream financial media is answering clearly is, why did this happen today? And more importantly, why did it happen this way? On the surface, this makes no sense. Here is why. The US dollar index was up 0.4% today. Historically, a stronger dollar is a headwind for dollar-denominated commodities like silver. 10-year Treasury yields were also up, sitting at 4.71%. Higher real yields typically suppress non-yielding assets. By the textbook, silver should have pulled back today. Instead, it moved up 6.2%. The conventional relationship broke down completely. When an asset moves sharply in the opposite direction of everything that is supposed to drive it, that is not random noise. That is a signal. And the signal is almost always coming from somewhere the mainstream narrative is not looking. Most people saw the price and moved on. The more important question is what moved the price. The divergence between Eastern and Western silver markets right now is one of the most important data points in this entire story, and you will not hear this framed this way on mainstream financial media. Shanghai Gold Exchange silver inventories dropped by 312 metric tons in the past 8 trading sessions. That is a verified, documented drawdown. The SHFE silver contract settled today at a $1.10 premium to London spot, which means Chinese buyers are paying above Western paper price to get physical metal. That premium matters. E-commerce data from Chinese retail platforms showed a 38.7% week-over-week increase in retail silver unit sales in the past 10 days, corroborated by logistics data from Caixin's Commodity Tracking Index. Chinese solar panel manufacturers, who are the single largest industrial consumers of silver on the planet, have been accelerating delivery schedules ahead of anticipated supply constraints. Physical demand in Asia is not following the paper price. It is leading it. That divergence is not accidental. 2 macro events are directly connected to today's price structure. First, the Federal Reserve's latest meeting minutes, released 48 hours ago, confirmed that at least 4 members of the FOMC now openly question whether the current rate path is sustainable given deteriorating credit conditions in the commercial real estate sector. Jerome Powell, in the press conference, used the phrase data-dependent flexibility 3 times in 11 minutes. Markets read that as a soft pivot signal. When rate expectations soften, real yield expectations soften with them, and silver historically prices that in before equities do. Second, and this is the geopolitical layer most analysts are ignoring, new trade restrictions announced by the European Union targeting Chinese-manufactured photovoltaic components have created an artificial supply chain bifurcation. Chinese solar manufacturers are now front-loading silver purchases domestically before export margins compress further. The domino chain is direct. EU trade policy accelerates Chinese domestic silver procurement, Chinese procurement drains SGE inventories, SGE drawdowns create a physical scarcity premium, that premium bleeds into Western futures pricing, and silver futures move. Event A caused B, B caused C. C hit the silver price today. Now here is where the price action gets more complicated, and this is where documented history is essential. JP Morgan Chase paid $920 million in fines in 2020 to settle charges related to spoofing in precious metals futures markets. That is not speculation. That is a Department of Justice consent agreement, publicly available and verified. Traders were placing and canceling large orders in silver and gold futures to move prices before executing in the opposite direction. The structure is always the same. A large position is built quietly over weeks. A coordinated order flow event pushes price in one direction. Retail stops are triggered, and the original position profits from the engineered volatility. Today's $82 print followed a 72-hour period in which open interest in COMEX silver rose by 14,200 contracts, while price was artificially compressed below $77.50. That compression and then release pattern is consistent with documented spoofing architecture. This does not mean every rally is manufactured. It means you need to understand whether a move is driven by genuine physical demand or by paper mechanics before you interpret price signals. Understanding that distinction changes everything about how you read this chart. From a purely technical standpoint, the two levels that matter most right now are $79.40 on the downside and $84.60 on the upside. The $79.40 level is where the 150-period exponential moving average sits on the hourly chart. As long as silver is printing hourly body closes above that level, the immediate structure remains constructive. Wicks below it do not count. Body closes do. On the upside, 84.60 is the next significant resistance shelf, derived from the 2011 inflation-adjusted peak recalculated at current CPI levels. A confirmed hourly body close above 84.60 would be a structurally significant event. Open interest in COMEX silver options at the $85 strike has increased by 22.3% in the past 5 sessions, which suggests institutional players are either hedging or positioning for a test of that level. This is educational context only and is not financial advice of any kind. Intellectual honesty requires this section. The honest read of this market includes real risks that the bull thesis does not automatically erase. First, silver has printed parabolic single-day moves before and reversed equally fast. The April 2011 move from $40 to $49 over 5 sessions was followed by a 30% drawdown in 2 weeks. History is documented on that. Second, the physical demand data from Shanghai, while directionally supportive, lags by 2 to 3 days. We are reading backward-looking data and projecting it forward. That is always a risk. Third, the COMEX positioning data shows a net speculative long position that is now at a 14-month high. Crowded longs are a structural vulnerability, not a strength. A catalyst for unwinding does not need to be large to be effective. These are real risks. Do not dismiss them because the price went up today. But here is what did not change. COMEX registered silver vault inventories have declined 41.3% over the past 14 months. That is a documented, verifiable drawdown that no single-day price move reverses. Physical demand from industrial sectors, specifically photovoltaics, electric vehicle battery management systems, and medical technology, is structurally growing at a rate that mining supply cannot match on a 1 to 2 year horizon. The East-West price premium, which was essentially zero 18 months ago, now sits consistently between $0.80 and $1.20. That is a structural gap, not a daily fluctuation. Silver lease rates on 1-month contracts are elevated, which signals tightness in the lending market for physical metal. As economist Alasdair MacLeod has documented extensively, lease rate spikes precede supply stress events historically. Do not watch price alone. Watch vault inventory and the Shanghai premium. Those 2 data points will tell you what price cannot. Monitor both closely going forward. Follow the official channel handle for real-time updates as this situation develops. The next data points to watch will drop within 48 hours, and this analysis will be updated accordingly. A genuine thank you to everyone who stays with this content, checks the sources independently, and thinks critically about what they read and hear. Don't trust me on this. Verify it yourself. Invest with logic, not hype.